Welcome back, everyone. It's been a thrilling morning so far. Tons of great questions. Please welcome our next presenter. We have Verde Bioholdings, Inc., trades on the OTC under the symbol VBHI, and is engaged in the acquisition and management of mineral and royalty interests in lower risk onshore oil and gas properties within the major oil and gas players in the U.S. So today we have its CEO, Scott Cox. And remember, all attendees, submit your questions for Scott Cox and Verde Bioholdings right here through our module, and we will get them answered. Welcome, Scott. How you doing today?
Very good today. Thank you for having us.
Good. We're excited for your presentation. The floor is yours.
All right, great. We're excited to be here. This is kind of our first introduction of the company and into these types of conferences, and I'm certainly excited to talk to you guys a little bit about where we've been and where we're going. So with that, we will move to the safe harbor. Just some of the things that we're going to be talking about today could be considered forward-looking statements, so definitely want to acknowledge this as we move forward into the discussion of the company. So Verde Bioholdings is based in Frisco, Texas. We're focused on acquiring oil and gas and mineral and royalty interests, as well as select non-operated working interests across the U.S. One major thing to think about us is that we don't drill wells, we don't operate wells, we're not subject to the lease operating expenses of the wells, and for the most part, we have zero capital requirements once we acquire our acreage. We've been doing this a long time, and acquiring the minerals and royalties and managing public companies. And during those times, we've been able to develop very extensive relationships with operating companies, landowners, and brokers to provide what we believe is one of the best deal flow markets in the business. A lot of times where we're buying this stuff is basically straight from the landowner, and that's a great place to be. As we look at our acquisitions, we focus on some strict principles about where we've been and some technically driven processes. And those things include, vetting the company. Who is it? Looking at the well count, looking at all of the different things that come into an acquisition. And then, just the way things have turned out with the company in the 2 year, coming up on 2 years that we've actually had control of the company, has turned out fantastic for us. We started this in a really low-priced environment. We've been able to make the acquisitions, ride those prices up, and the abundance of deal flow and what that looks like has been able to help us make the acquisitions. And we're seeing more and more capital come into it. And we're very excited and very bullish about where we're heading and what we're doing with the company. So let's talk about where the company's been, what we've done so far, and where we're heading, or what we like to call or refer to as a game plan to increase shareholder value. We took over the company in late 2019. I believe it was mid-November. The company at the time, due to the previous management, was, I believe, 5 Qs and a K behind. We brought it current by about mid-May or June 2020, and then it was off to the races, given the current pricing climates and the deals available. So during that time, we launched a Reg A offering. We raised $10 million through the Reg A. We focused on that number because we believed it actually created a critical mass for the company as far as assets go, revenue goes, and where we needed to be in order to support the company as a public company, but also have a very diverse and good portfolio of assets. We wanted to go ahead and do that and reach that critical mass because we didn't want to do any more major dilution to the company or things that could possibly hurt the company. And so we decided to do it all right there at that one time. And again, we don't, we believe that we've executed on that successfully, and we don't forecast any major dilutive events for the company. And so with that money, we've made 16 significant revenue acquisitions to date. Total, those include 391 wells across 7 states and 23 major operators in 8 different reservoirs. We've been able to clean up our balance sheet. We're now debt-free and very proud to say that. No more convertible hanging over. And one of our main goals with this company was to achieve a penny stock exempt status. And we did that. The penny stock exempt is important. I believe that it helps to really legitimize the company, open it up to major market makers looking at us. We're able to start working with the major analysts and really get us on the radar of much better trading. With those year-to-date acquisitions, basically they were based on an average of around $45 oil and $2.25 natural gas, which equates to significant cash flow. When you look at the current environment and pricing environment with commodities, we can estimate right around $250,000 a month or $3 million annually in revenue at this time. And we're going to be reinvesting those proceeds from the cash flow and any opportunistic divestitures that we focus on, and continue to grow the portfolio and the asset base of the company, thus the revenue, and propel the company forward, really. When we look at long-term growth, as we've discussed before, we do directly benefit from increasing commodity prices. This means that we bought these things based on, as mentioned before, $45 oil and $2.25 gas. Those prices have basically doubled, if you will. Oil's well over 80 right now, and gas is over 6. And so gas has almost tripled. But so we have the ability to benefit from those. And so that as commodity prices rise, so does our revenue in relation to that. During these times, in these higher commodity prices, we see organic growth from operators drilling new wells on our acreage and completing the drilled and uncompleted wells, and even reworking some wells. We also have the ability on a long-term focus to diversify our royalty assets with strategic non-operated working interest with the major companies where we're direct. We're not carried, or they're not carried in any certain way. We're not paying a bunch of extra fees, and other potential acquisition opportunities that we might run across. One great thing to remember about Verde is our interest provides significant exposure to perpetual ownership of largely undeveloped assets with zero capital requirements to provide sustainable free cash flow. So as we talk about acquisitions, let's talk about our investment thesis. And so what we look for and what we acquire are assets that have high margins, no capital requirements, and limited operating costs that drive the continuous free cash flow. We look for core mineral assets under high quality, well capitalized, and when we can, pure play operators. We like the pure play operators because they've got a stronger incentive to develop assets and they are experts in their given area. Our deal flow is concentrated on smaller, under the radar assets from distressed owners and others. We like this because we're not in competition and we don't get into bidding wars with the larger companies that would be our competitors on those deals. We believe that we can roll up smaller deals and create very nice portfolios rather than spending a lot of money on one major portfolio and overpaying due to the competitive nature of it. We also are able to directly benefit from the technological advances to enhance oil and gas recovery. Oil and gas is always working to increase technology and recovery from these things, and working on fracs, taking them longer, doing super units in the Bakken and places like that. And so we have the ability to have direct benefit of those. And also we have organic growth during these times from the rise in oil and gas prices with new drilling, as I mentioned, the completion of drilled and uncompleted wells on our acreage, and you know, the overall just development that goes with these high times. So our portfolio strategy is, as we've mentioned, our acquisition strategy is based on largely pure play operators focused on developing the acreage. We also look at a blend of developed and undeveloped acreage. So not only do we have historic revenue production from some minerals, we also have the upside of undeveloped acreage with potential of new wells being drilled and the significant revenue that can come from those. We also, when we look at building a portfolio, we try to have a really diverse ratio of natural gas and oil, and that gives us the ability to take part in the various times. If natural gas is high and oil's lower, then we're in a good position with our gas holdings. If it's vice versa, we're in a good position with our oil holdings. That leads us into divestiture strategy. We have an active portfolio management, and with that, we're open to opportunistically divesting assets at significant profits, which will just turn around and be reinvested into the company into other deals. With that active management, we have the ability to lay off assets that may not be performing very well. If we're in a very high priced and active natural gas market, and we've got some what I'll call non-core oil assets that are lagging behind, and then we have the ability to lay those off and reinvest that into something that will add some value and some significant revenue back into the portfolio. You know, the divestiture strategy, we utilize relationships that we have in the retail markets, which would be large institutional type buyers, endowments, things like that, as well as 1031 exchange. Lots of people in the 1031 world are looking for these types of assets. Minerals do qualify as a real property under the tax code. So there's significant opportunity to lay these off into and make a profit and move that back into the company. As I mentioned, we're very bullish about the markets we're in and the sector we're in right now. If you look at U.S. energy consumption of 2020, petroleum and natural gas are still there. We believe they're going to be there for a long time. And even as people begin to push the renewable energy, it's still going to remain largely fossil fuel driven. And so we're very, very excited about the next few years and where this will take us. When you look at U.S. energy production in 2020, natural gas is the leader, with crude oil right behind. And so we're excited about those. We're excited that we had the ability to see a little bit forward and make some major acquisitions in our gas portfolio. And we're excited to see where these both go. If you look at natural gas prices, where we are now, they have almost doubled, they've almost tripled since the beginning of 2021. We're over $6 an MCF. And as I mentioned before, most of our gas properties were bought with a basis of around $2.25. So we've seen incredible appreciation in our revenue, and we're able to forecast that into the coming months. When we look at West Texas Intermediate, we can see that it's going up as well. And so this is a great environment. We're excited about what this does for us as a whole, with revenue, with long-term growth in new drills. All of those things coming in will help to propel the company into the future. We believe that with the oil pricing being high, we will see significant development in a lot of our areas. If you look at our DJ Basin, for example, it's profitable down to $40. So they're going to be really ramping up there and beginning to develop and to complete the drilled and uncompleted wells that are sitting there as well. So for our portfolio overview, what we've got so far, we've got, as I mentioned, roughly 390 wells across 7 states, 23 operators, and in 8 different reservoirs. When we look at them by reservoir, you can see the Permian is where is the Permian and the DJ Basin are where the majority of our oil is located. We've got the Utica, the Haynesville, and the Marcellus for our natural gas holdings, and we're actually very excited about the way the portfolio is built right now. Well count by state, given the Permian, we've got and some of the acquisitions we made, which were a high well count, where the majority of our wells are in Texas. Then we go to Colorado, Louisiana, Ohio, Oklahoma, Wyoming, and West Virginia. Our Haynesville highlights. We're very excited about Haynesville and what we've got there, and what we believe is coming down the pike. Our assets are under Aethon, which is a very, very well-funded company, very active, has solid development plans, as well as Vine, which was a pure play operator, and Indico, which was a pure play operator in the area. If you look at Vine, they're a leading pure play Haynesville focused on delivering strong ESG, which we directly benefit from with their development. Southwestern just acquired Indigo in a $2.7 billion transaction. We're excited about that. We had some of our Marcellus and Utica interests were under Southwestern, so we're now excited that they've made the acquisition of Indigo, and it's a combination of 2 pure plays. So we're excited about that. Aethon again is a major company, and we look forward to their development as well. We move into the DJ Basin and what that looks like. There is, we're excited about this low price and low profit level oil development. We've got very good assets under extraction, Bonanza Creek, EOG, and Great Western in this area. Bonanza Creek has acquired extraction, and so we're excited about seeing what they do with these companies and as they start to go. One thing I wanted to mention is we do like publicly traded companies, because when we look at deals, we try to find them under the publicly traded companies, because we're able to really understand their development plans. They file, and we're able to understand their reservoirs and their engineering and their reserves and what they're talking about, as well as development plans as they start to drill and rework wells, etc. And so with the DJ Basin, again, we've got Bonanza Creek. They just acquired High Point Extraction, Crestone, and Great Western is also a really good pure play operator in the DJ Basin. We're excited about that. The Permian, everybody loves the Permian. We're very excited about our holdings in the Permian and what's to come with those. We've got holdings under EOG, Fleur de Lis, and Oventive. Oventive was the successor to Encana, so we're looking forward to what they can do with these assets out here, and of course EOG is one of the majors that everybody wants to work with. They're good. They've got a long runway of projects out here, and we're really looking forward to that. And so when you look at EOG, again, I mentioned we love the publicly traded companies. They have for 21 plan in the Permian. They've got 145 net planned well completions. Right now they're running 3 rigs and 2 frac crews, and they've got high grade location selections to double premium. The Oventive, they're located in the oil-rich Midland Basin, and focused on the development of the Sprayberry and Wolfcamp as a combination. And Fleur de Lis, they've got a huge holding out there, and we're very much looking forward to seeing what they do with our acreage out there. The Picky Ants and Powder River. The Picky Ants is a small gas formation in northwestern Colorado. We were able to pick that up in a package, but we're actually excited to see what can come of that. Again, EOG in our Powder River in Laramie County, Wyoming, and they're active up there. They've got good development plans, so we're really looking forward to seeing what they do as well up there. And so that leads us to key takeaways, things we've talked about. We've come a long way in less than 2 years. We're very proud of that. We've made over 16 acquisitions. We've completed the Reg A. We're debt free. We've achieved penny stock exemption status. The next goal is the uplist to the OTC QB. We've made all of the applications, and we're working through that, and we're hoping that comes through soon. We've got very good free cash flow that we're able to forecast, and we believe that that's just going to continue to climb. And then for our long-term growth, we're very bullish as far as the oil and gas markets go, and where Verde sits as a company. When we start to look at that, we're going to have great cash flow. We're going to have great organic growth for the new drills, all of those things. And we believe that we're very well positioned to move into the future and to really begin to add some shareholder value to the company and take it up to the next level. We had a lot of questions that were submitted to the company in the early days leading up to this. We've tried to incorporate a lot of these into this presentation, so I hope we've touched on those, but I know there's other questions that are out there. And I think, Anna, if we want to open those up now, I think that's great.
Absolutely. Thanks, Scott. Great presentation. Okay, so Griffin H. asks, recently the company was delinquent on a couple of filings. What steps has the company taken to ensure future reporting is on time?
Yeah, the delinquency I hated it. It killed me, and certainly something we apologize to our shareholders about. So we believe that we have the issues fixed. We've engaged a major oil and gas accounting firm, which will be handling our revenue from now on. They're working on a proactive basis. So they'll be making the oil and gas accounting level, which was what was introduced that we had to start doing. And with our regular accounting teams, and everybody's beginning to work proactively on this, so we don't have this issue anymore.
Good. Les Robinson asks, what has the drastic increase in commodity prices done for the company, and how does it affect near and long-term projections?
Great question. So the increase in commodity prices helps in 2 different ways. Near term, it's cash flow. We're able to really, as I mentioned, we're able to ride the commodity prices up from where we bought and get direct benefit from that. And as we look into more of a long term, that's where those new drills come in and the completions come in of the wells that are sitting out there. And we're able to really take those in, because with this higher price environment, you're going to see a lot of new permits filed, a lot of new completions filed, and those things are all going to be coming into the market. And we will get those when they're connected with our acreage.
Larry Buchanan asks, what is the company's strategy for continued acquisitions in the higher priced environment that we are in now?
Yeah, so that is a challenging thing as these go up. It's kind of a two-edged sword. But where we get in this type of environment is we really start to look towards more undeveloped acreage where we can still buy that fairly inexpensive, but it may already have a couple of permits on it, where we're going to have, on a long-term basis, we can anticipate some really nice cash flow from that. The other thing is that these higher prices do bring more sellers into the market. So, there's much more opportunities to acquire, but you do have to be much more strategic about it and make sure that you're getting some near and long-term benefit from the acquisitions.
Mike Vasquez asks, what is the status of the uplisting to the OTCQB?
Great question. We get this a lot. So right now, we've made all the applications. They're all turned in. We are working with the OTCQB on questions or edits that have to be made to those. And we believe that we'll achieve that OTCQB status fairly soon. And I think we're on the tail end of all that.
Marlon Hammonds asks, when do you think you'll be cash flow positive?
I believe we'll be cash flow positive third to fourth quarter of this year.
Stavros Papazoglou says, hello and congratulations for your effort, Mr. Cox. I want to ask you, when do you believe we will have an uplisting to the OTCQB or OTCQX? And some of these are a little redundant, but you never know when someone's popped on.
Yeah, no. That's great. Love to touch on it again. So we believe that, as I mentioned, we've made all the applications. We've got everything turned in. We're working with them and answering various questions, concerns, et cetera. And I believe we're in the tail end of that. And I think we'll see that fairly soon.
Great. Kaylee Schmoyer says, do you have a list of potential investments? Do you see getting out of OTC itself altogether?
So we do. We always have a good list of acquisitions that we look at and keep those and really try to work through those as far as allocating capital, allocating time, what's good, what's bad about those. And so yeah, we are constantly reviewing deals. That's what we spend the majority of our time doing, and seeing what works best and adds best to the portfolio at that current time. I'm not sure. We've talked about a potential NASDAQ run, but we're just kind of taking it step by step. We believe that we'd really like to see what the company looks like at the QB level and maybe the QX level once we get there. And if times dictate that, then certainly we would look at something higher than that. But when we do that, we really start to run into some other competition in very large companies that do the same thing we do. So, it's something we're watching and considering.
All right, Scott. Well, that's all the time we have for your presentation, but we've got tons more questions coming in from our viewers. So we'll submit them to you so you can answer them on your own time. But please come back and join us again at another conference and give us some more updates. Thank you for your presentation.
We'd love to. Thank you guys for having us very much.
All right, everyone, stay with us as we transition to the next presenter. We'll be right back.